Joining me is Lance Roberts, Chief Investment Strategist at RIA Advisors. Now, we have the CPI report later this week. What do you think is the big question that the market is looking for the CPI to answer?
Well, really, the issue is whether or not inflation is falling at a pace that is fast enough to get the Federal Reserve to stop hiking interest rates. And, as Jerome Powell stated at the last FOMC meeting, he said, inflation is nowhere near our target rate of 2%. We need to see a sustained path towards that 2% target rate. So what the market's looking for is inflation data that shows that inflation is truly heading towards that 2% rate. Unfortunately, some of the employment data and other things that we've gotten suggest, and when we take a look at what we call the core CPI, which is stripping out some of the variability like energy prices, that has remained very sticky. So what the Fed looks at as core, and some of the economic data suggests that inflation isn't coming down as fast as the Fed would like.
Now, on the topic of recession, a strong case can be made about one happening this year. Now, what is the market saying, and what is it betting?
The market, it's kind of interesting. The market's betting on the idea that the Fed is going to be cutting rates by July. In fact, if you look at Fed Fund futures, which is the prediction by the market of what the Fed's going to do, it's vastly different than what Jerome Powell and the Federal Reserve have been saying, which is we're going to hike rates to 5% and we're going to stay there for a period of time, like the rest of this year. The market's expecting rate cuts to start in July and have as many as 110 basis points of cuts by year end. That's a very different outcome the market is betting on than what the Fed is saying.
And why do you think that is? Why is there such a difference?
Well, the market is hoping for a return to liquidity, right? So lower interest rates, monetary accommodation, and because that's what makes stock prices go up. For the last 12 years, we've had several rounds of quantitative easing, zero interest rates, and 12% annualized rates of returns from stocks. And the markets have become addicted to that type of environment. The problem, though, is that if the economy is doing well, if the markets are doing well, if inflation is coming down, there's no reason for the Fed to cut rates. So, what the market is wanting and what the Fed is doing are two very different things. If the Fed is cutting interest rates, they'll only cut rates because there's a problem. There's a financial event, a banking crisis, a recession, or a bear market. And so if the Fed is cutting rates, there's nothing good that's going on in the markets that you want to be invested in stocks.
I see. Now, earnings season upon us. What's your outlook on earnings this season?
Well, earnings have come down a lot. So at the beginning of this year, if we go back and to May of last year, pretty much, estimates for the first quarter earnings were at about $225 a share. We're now down to $172 a share. So earnings have been lowered dramatically going into Q1. So as what we'll probably see is companies beating estimates by a very small margin. It's what I call millennial earnings season because we lower the estimates so much that everybody gets a trophy. So we'll probably see a fairly decent beat rate. The thing to pay attention to, though, is what do these companies say about the rest of this year? Are they seeing a recovery in the economy? Are they seeing a recovery in earnings? Do they see a stronger economic environment that they will look to hire into? Those are going to be the more important questions, I think, for investors to pay attention to, is what that outlook looks like for the rest of this year.
I see. I mean, the Fed is forecasting unemployment to go up to 4.5, I think.
Right.
What are your thoughts on that? How should we be reacting to that?
Well, if the Fed gets there, so let me back that up. If the Fed wants to have lower inflation, they have to have slower economic growth, right? I mean, that's how we bring demand down. So inflation is only a function of supply and demand. So if you have too much demand and too little supply, which we had over the last year or so, you have inflation. So if you want to reverse that, you've got to bring down demand, and you do that by raising interest rates, borrowing costs, contracting loan demand, which is what we're seeing in the economy right now as well from banks. So that is going to slow the economic environment. If we're getting to 4.5% unemployment, we're talking about a recession in the economy. And again, this is kind of what the Fed's been talking about for a while. They said, in order to get inflation to our target, we need to experience some pain, and that pain is going to be higher unemployment rate. That is not going to be great for the stock market, by the way. So as investors, we need to be really cognizant of that. If we start to see employment rising pretty sharply, that's not going to bode well for corporate earnings.
Now, I remember you saying previously that if everybody expects the same thing, that it might not happen. Do you think that's the case with inflation here? I mean, with a recession here?
Yeah, the one thing last year that we had in particular was we had everybody expecting a recession. And that's now become not as popular of an opinion. Now the more popular opinion is a no recession scenario. So now the market and analysts are betting on an environment where we don't have a recession. So this actually increases, the ability for the markets now to have that recession later on this year. Look, if you take a look at all the economic data, it suggests we're going to have a recession because of higher interest rates, lower demand from consumers. It's just how the economy works. It's just not going to happen as soon as many people think. It'll probably be later this year, maybe even early 2024, because we still have to bring that demand down. And that's going to take a little while to do that.
Okay, one last thing. In today's live show, you said the market will not make you rich. That was very interesting. Would you like to expand on that?
Sure. The thing is that people, look at the stock market as the get rich quick kind of machine, right? I'm going to invest, some money, and I'm going to buy some stocks, and they're going to go up a lot. And that replaces my need to save money. My investments will take care of my savings for me. And that's not how the markets are designed to work. The markets are designed to make sure that your savings are growing at the rate of inflation over time so that you maintain that purchasing power in the future on your savings. But if you start treating the market like a casino, it'll treat you like a casino. And as is always the case, the house wins. So if you gamble in the market, you're going to wind up losing money. If you invest to grow your savings at a conservative rate, in order to make sure that those savings are there in the future and you're saving aggressively for your retirement, the market will treat you well and you'll be very successful in the long run. But the market is never a get rich quick scheme. And if you treat it that way, you're going to wind up losing your money.
Now, if the market is simply for maintaining value of your money against inflation, what if inflation is at 2%? Does that matter?
Yeah, it matters a lot, because if inflation's at 2%, then I don't need to go take risks to generate 7 or 8% a year. And see, the more I want in terms of return, the more risk I have to take. Risk is not a function of how much money I make in the markets. It's how much I lose when I'm wrong. And this is why, even though the market was down 20% last year, retail investors lost more than that. So they destroyed years of earnings in their portfolios by losing money in the markets last year. And so this is why it's always very important. You don't take more risk in the market than what you need, because again, if I take more risk, I suffer bigger losses, and losses are far more important to my portfolio returns long time than just making money.
So if inflation is at 2%, then you only need to take enough risk to make a 2% profit. But if it's at 5 or 6%, you will have to take more risk.
That's correct. And look, people always say all the time is that markets average 8% a year. And that's true. The average rate of return is 8%, but markets don't return 8% every year. So just an example, last year markets lost 20%. Well, if I needed 6% a year to get back to make my retirement goal, I not only have to recover the 20% I lost last year, but I also have to make up the 6% I didn't get. So it's actually 26%. So if I make 10% this year, I've still got to make up the loss I had, plus the additional 6%. And this is why these compounded rates of return that everybody talks about never really happens in the markets. And you're always behind the curve once you lose a lot of money. So managing risk in your portfolio and how much you're trying to get out of the markets is very important to make sure that risk is in line with what the markets can actually generate.
I see. All right. Thank you so much, Lance. Always great to have your comments.
My pleasure as always. Thank you for having me.